Microsoft stock falls 10% after earnings. Why strong cloud growth wasn't enough. The financial markets delivered a stark reality check to Microsoft on January 29, 2026. Despite posting revenue and earnings that comfortably cleared Wall Street's hurdles, the tech giant saw its stock price tumble by 10% in morning trading. The sell-off underscores a shift in investor sentiment. In the era of generative AI, beating the numbers is no longer the sole metric for success. Investors are now laser-focused on the cost of that growth and the long-term return on investment (ROI). The paradox of the double beat. On paper, Microsoft's fiscal second quarter results, ending December 31, 2025, were stellar. The company achieved a double beat, surpassing analyst expectations for both the top and bottom lines. Key metric reported, Q2 FY26, Wall Street estimate total revenue $81.3 billion, $80.3 billion EPS. Non-GAAP, $4.14, $3.91 Azure growth 39%, 38% cloud, revenue $51.5 billion, $50 billion export to Sheets. Despite these wins, the market reacted with aggressive selling. Here is why the strong cloud narrative failed to keep the stock afloat. 1. The CapEx explosion, the $37 billion question. The most jarring figure in the report wasn't revenue, it was capital expenditure, CapEx. Microsoft spent a staggering $37.5 billion in a single quarter, a 66% increase year over year. The majority of the spending is funneled into data centers, NVIDIA GPUs, and custom silicon, like the new Maya 200 chip, to power the AI revolution. While CEO Satya Nadella framed this as building the AI superfactory of the future, investors are growing wary of the spending intensity. The concern: the market is worried that margin compression will set in before the AI revenue fully matures. When you spend $37 billion a quarter, the break-even point for those investments feels increasingly distant. 2. Azure growth, stability versus re-acceleration. Azure, Microsoft's cloud computing crown jewel, grew by 39%. While this technically beat the 38% forecast, it represented a slight deceleration from previous quarters. For a stock trading at a premium multiple, investors weren't looking for solid, they were looking for spectacular. The slight dip in the growth rate suggests that even with massive AI integration, the cloud business is maturing, making it harder to sustain the hypergrowth rates seen in years past. 3. Capacity constraints, demand without supply. In a surprising admission, CFO Amy Hood noted that Microsoft is currently capacity constrained. Essentially, the demand for AI services is so high that Microsoft doesn't have enough hardware to satisfy it. While this sounds like a good problem to have, it means Microsoft is leaving money on the table in the short term. Furthermore, it revealed a strategic trade-off. Management admitted they are prioritizing internal developers for products like Copilot over some third-party cloud customers to ensure long-term R&D dominance. 4. The OpenAI concentration risk. Microsoft's fortunes are increasingly intertwined with OpenAI. This quarter, Microsoft revealed that a significant portion of its expanding cloud backlog and its $625 billion in remaining performance obligations (RPO) is tied to its partnership with the ChatGPT creator. This concentration risk has analysts nervous. If OpenAI's funding or growth trajectory hits a snag, Microsoft's cloud numbers could be disproportionately affected. The bottom line: Microsoft remains the foundational player in the AI era, but the show me the money phase has officially begun. The 10% drop isn't a reflection of a failing business. It's a recalibration of expectations. Wall Street is no longer applauding the promise of AI. It is now auditing the cost of AI.